Welcome to Section 6 of our ASC 470 Debt Accounting course. In this section, we are going to cover two topics that come up constantly in practice: convertible debt and revolving lines of credit. Both have specific rules that differ from standard debt, and one of them went through a major overhaul just a few years ago. Let's get into it. By the end of this section, you will be able to identify the default single liability treatment that applies to most convertible debt today, recognize the two narrow exceptions that still require bifurcation, explain how the old model worked and why it inflated interest expense, apply the special issuance cost rule for revolvers, and correctly classify revolver balances and handle commitment fees. These are practical skills you will use on real engagements. Here is the key thing to understand about convertible debt. It is a hybrid instrument. It starts as debt, but it carries an embedded right to convert into equity. That right belongs to either the holder or the issuer, depending on the terms. Because it straddles the line between a liability and equity, it has always been a tricky area to account for under US GAAP. Accounting Standards Codification 47020 is the primary guidance. The complexity comes from one central question: do you account for this as one instrument or two? The answer has changed significantly in recent years. The Financial Accounting Standards Board, FASB, recognized that the old convertible debt rules were overly complicated. So in 2020, they issued Accounting Standards Update 2020-06, which dramatically simplified the model. Most public companies adopted this by 2022, and most private companies by 2024. But here is the watch-out: instruments issued before adoption may still be under the old rules. When you pick up an engagement involving convertible debt, your first question should always be, which standard has this entity adopted, and when? The answer changes everything about how you analyze interest expense. Most people assume convertible debt still requires complex splitting between a debt piece and an equity piece, but that is not what happens under the post-ASU 2020-06 model. The default treatment is now beautifully simple. The entire instrument is recorded as a single liability. You do not carve out an equity component. You do not record a debt discount. You simply account for the instrument as you would any other debt. Interest expense now much more closely reflects the coupon rate you actually pay. For most convertible instruments your team will encounter today, this single liability approach is where you start. Here is where it gets more nuanced. There are two exceptions to the single liability default, and the first one involves derivatives. If the conversion option in your convertible instrument meets the definition of a derivative under a SC 815 and does not qualify for any exception from derivative accounting, you must bifurcate it. That means splitting the instrument. One piece is the host debt, the other is the derivative. The derivative gets measured at fair value at every reporting date, and changes run through earnings. This analysis requires a close look at the settlement terms. Things like variable conversion prices or conditions that could trigger net cash settlement. The second exception is narrower and less common, but worth knowing. If a conversion option embedded in debt was issued as part of a share-based payment arrangement to employees, it falls under a SC 718, the stock compensation standard, not the standard debt rules. You account for the compensation component separately, measuring fair value at the grant date. The surprising part is that this distinction matters a great deal for income statement presentation. Compensation expense and interest expense are very different line items. If you ever see a convertible instrument tied to an employment agreement, flag it immediately for this analysis. Before a SU 2020-06, convertible debt with a cash settlement feature required bifurcation, splitting the instrument into a debt piece and an equity piece. The equity component was measured at fair value and parked in additional paid-in capital. The debt component got whatever was left over, which was always less than face value. That gap became a debt discount. And here is the critical effect. That discount had to be amortized up to face value over the life of the instrument, which showed up as additional interest expense on the income statement. You may still encounter this on older instruments that were issued before the entity adopted the new standard. The practical impact of this is significant. Under the old model, a company paying a 3% coupon on convertible debt might report an effective interest rate of 7 or 8% because of the discount amortization. Under the new model, interest expense is much closer to that 3% coupon. Watch out for this one when you are comparing two companies or two periods. If one is on the old model and the other is on the new model, their interest expense is not comparable on its face. This also affects debt coverage ratios, EBITDA, and earnings per share. Always confirm which accounting model is in use before drawing any analytical conclusions. Shifting gears to revolving lines of credit. A revolver is one of the most common debt instruments in corporate finance. It works like a credit card for companies. You can draw funds when you need them, repay when you have cash, and draw again. The balance moves up and down throughout the life of the facility. That flexibility is exactly what makes revolvers useful for managing working capital. But that same flexibility creates accounting wrinkles that do not exist with straightforward term loans. The rules around issuance costs and classification for revolvers are specific exceptions to general debt accounting, and they trip people up regularly. Here is one of the most frequently tested exceptions in debt accounting. Under the standard rule, issuance costs are shown as a contra-liability deducted from the carrying value of the debt. But for revolvers, that approach breaks down. Why? Because a revolver can have a zero balance. If you owe nothing on your revolver today but you paid fees to set it up, where do you put those costs? You cannot deduct them from a liability that does not exist. So GAAP requires you to present revolver issuance costs as a separate asset on the balance sheet. And that asset is amortized over the full facility term regardless of whether the revolver is drawn or sitting at zero. Two more practical rules for revolvers. First, classification. The drawn balance on a revolver follows maturity. If the facility expires within 12 months and cannot be refinanced under an existing long-term arrangement, the balance is current. If it is a long-term facility, the drawn balance is non-current. Simple enough. Second, commitment fees. Most revolvers charge a fee on the undrawn portion. You pay to keep the line available even when you are not using it. The surprising part is that these fees are not deferred or capitalized. They are expensed as incurred. They are period costs, full stop. Do not let anyone tell you they should be treated as additional issuance costs. Let's bring it together. After ASU 2020-06, the default for convertible debt is a single liability, clean and simple. But watch for the two exceptions: derivative features under a SC 815 and employee compensation arrangements under a SC 718. For legacy instruments, the old bifurcation model may still apply, and it produces materially higher interest expense, so always verify before drawing conclusions. On the revolver side, remember the two key exceptions to standard debt rules. Issuance costs go on the balance sheet as an asset, and commitment fees are expensed as incurred. These are the rules that separate sharp practitioners from the rest. Thank you for completing this section on convertible debt and revolving lines of credit. Thank you for watching. Subscribe for more training from PNJ Group.